How can I afford to buy a house when the monthly mortgage payment is so much higher than the rent I'm currently paying on my apartment? I get that question quite a bit in my mortgage practice. And as a mortgage advisor, the first question I always ask is, what are we trying to do? What are you trying to accomplish with this home purchase? Because one of the things that stands out to me, if your monthly mortgage payment is substantially higher than what you're paying for rent, you're looking at a house that is substantially bigger or more improved than where you're renting. For example, if you're renting a 1,200 square foot apartment and you're paying $2,000 a month, if you divide that $2,000 a month by the square footage, and then you multiply that number times the square footage of the house that you are looking to buy, you might be surprised that the payment is actually less per square foot per month than what you would see on a rental, which simply means that you're not really comparing apples to apples. The second thing that we need to understand is that those monthly mortgage payments include things like taxes, insurance, potentially mortgage insurance, potentially homeowner association fees, and things like that, that are being absorbed by your landlord in your rent, which again probably means that if your rent is substantially lower, the apartment that you're renting or the house that you're renting is probably inferior to the one that you're buying. The third thing that you need to understand is that every month when you make your mortgage payment, you are actually paying some of the principal down. And that is like a forced savings account where over the course of time, that a little bit of principal that you pay every month adds up and can be substantial. And the fourth thing that you need to understand is that unlike rent, because you own the house you have a mortgage on, you're able to take advantage of the appreciation year over year on that house. Now, we can't guarantee any particular amount of appreciation or what it's going to do in any particular year, but historically, houses have increased in value 3 to 4% per year, some years more, some years less. But over the course of time, that's how it shakes out. So over the course of time, as you make your mortgage payment, then the appreciation gain that you get and the money that you've paid off on the mortgage, we call that amortization gain, can result in a fairly substantial nest egg to put down on the next house that you want to buy, to move up a little bit more. So you don't have to go from an apartment to your dream home that you want to live in forever. You can go from an apartment, take a step up to a little bit bigger of a house that is still maybe small on the house side, but allow you to gain equity, because generally those starter homes are going to appreciate quicker and more than something that is more of a luxury house anyway. So if you have any questions about renting versus owning, and there are times when it doesn't make sense to buy and you're better off renting. But for about 2/3 of the people in America, buying is absolutely the best decision that they need to make. And so if you're wondering which group you're in, buyers or renters, reach out to me. I'd love to help you in any way that I can make sense of the market and become a successful homeowner and create generational wealth. Hope you have a wonderful day.